most likely gold will rally to a realistically plus or minus $8,000 fair value per ounce.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, and welcome to the show that is brought to you by Kinesis Money. And this is the show, again, that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis's very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering more of your questions. That's right, Live from the Vault community questions are coming up. So let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, here we are again, just 2 weeks on, and there's so much to catch up on. It seems like it's more than 2 weeks. There's so much going on there. Now, I've got a bunch of questions that we've kind of aggregated. They're coming from the community. They're coming from subscribers, and most of the questions really relate to the short-term volatility that we're seeing, as you expected in silver, to outperform once again against gold. And so can we start right with that outperformance, silver to gold?
Hey, great to be with you, Shane. Great to be with everybody. Thanks for the questions. There's just so many, I guess, really back to getting Shane to sum them up. But yes, so in our last episode, what we did was drew public attention to what was really the clash, as we called it, of the Citi versus the Goldman Titans as we exited the end of the second quarter. Now, if you remember, we recorded that episode just, I think, 3 days before the end of the quarter on the Wednesday, and then the quarter ended on the Monday. Now, what we would in particular drawing attention to is how Citi had led a move by the LBMA market makers to force this unnecessary producer hedging. And the object was to drive a synthetic discount into the 30th of June. And if you remember, it was a big event. We talked about it. It was the Office of the Comptroller, the OCC bets, also the Bank of International Settlements mark-to-market event. We've been tracking that for many, many, many months. I think 15 or 16 months now, where we've seen the Bank of International Settlements, the borrowings from the Fed. There's only one central bank borrowing gold from the Bank of International Settlements, and that is the Fed. And everyone else is don't want to be involved in any kind of synthetic structures with gold. There's a massive unallocated to allocated imbalance. We drew attention to that. We'll put another link out just to remind you about that. And really, so this event was huge. Now, it was important to the LBMA and the Fed. Now, we're focused on how captive producers have been corralled into selling, but how this is actually ultimately going to backfire on these predatory LBMA bad actors. By no coincidence, this forced selling drove both gold and silver into fresh June lows. But as has been the case over the last 15 months, this counterintuitive paper market selling is once again setting up the process of forging, and I use the word forging. I know it means two things, but we mean it in both senses, forging yet another higher physically driven stairstep on the way up to, as we will look at, $8,000 gold. And there are reasons for that. And as we've been drawing attention to, following the 15 months since the Shanghai Futures Exchange launch in March 2024, we've reached the inflection point where global physically settled markets have sucked sufficient liquidity out of the COMEX for it to ultimately become Basel III compliant or be drained of every single ounce of gold. And, we see these games going on. They are short term. So we want to talk, and this is why we're answering these subscriber questions. So as we drew attention to in that last episode, what the LBMA have done is they've resorted to attacking a fast dwindling number of captive producers. Now, the LBMA cartel rinse of the captive finance producers, remember we talked about how they own them in the sense they finance them, reflects very short-term thinking and is structurally running thin on how far these bad actors can push producers to actually synthetically forward sell production into Citi's ludicrous 2600 2026 target, which Citi, head of commodities trading, once more this morning trial ballooned when he was he'd just come out of the OPEC oil meeting in Vienna today, and he wanted to made a point of, out of the blue, wanting to reassert that target. Now, while this counterintuitive unallocated gold to central bank physical demand imbalance is understood by these well-connected producers, naturally, they're on the ground, under existing financing agreements, they can't risk being debanked, so they have to comply. But this kind of predatory malfeasance will ensure producers seek future financing and joint ownership relationships with Chinese BRICS bullion banks. That's what's been happening in silver. And the LBMA CME there's only one tool left in the Fed's fast depleting box of price suppression tricks, and that's it. So behind the ebbing COMEX action, there's only one global central bank still fighting the dollar price of gold. That's the Fed. And every other central bank, without exception, and sovereign, is aware the Fed is in the last stages of unwinding billions of dollars of gold derivative positions ahead of what is an inevitable gold revaluation event. These are historical positions that have built up over 50 years. They are enormous, and we are highlighted exactly where they live in the OCC report last time. So from a central bank, a competing central bank, sovereign, why not sit quietly back while the Fed agents banks, in this case Citi and JP Morgan, try to lay off as much of these underwater liabilities on what is actually a dwindling number of speculators as possible. Now, with China now taking control of the reins, really, this has become a losing battle for the Fed as the BRICS nations are capitalizing on these synthetic discounts. They're buying everything on offer, which is precisely how these sequential higher stair steps are being anchored. And this was particularly onerous, though. It was the nature of this forced producer hedging, forward selling, essentially, with Citi and JP Morgan undoubtedly taking the long side of these forced sales benchmarked at the fixes. They know there is a strong unallocated to allocated imbalance. What do you think they're doing? Of course, they're taking the long side. Now, recall the OCC report lists that these two banks were the only two banks. Remember, we published them last time. That report's available. And these were the only two banks that had not yet exited derivative bets that had stretched out 5 years. So clearly, they're acting on behalf. These banks are not acting on their own behalf. They're acting on behalf of the Fed. These banks are long physical for their own books. Now, our first-tier liquidity providers completely affirm the producer selling was collusively instigated by Citi and JP Morgan desks, sufficient to benchmark what has been a sequence of AM and PM fixes as low as possible, with the object of marking billions of dollars of derivative bets to market into the OCC BIS mark-to-market event. Then they were going to take the long side of these forward sales. It's that simple. So just to understand, while tricked-in producer forwards represent non-deliverable, non-Basel III compliant unallocated gold, and will ultimately be squared internally on the LBMA's books, the 20% haircut that they've been hanging on to desperately, trying to avoid the Basel III regulations to to impact their unallocated positions. And this 20% haircut is attributed purely to unallocated gold. And what it's done is it's clashed against very large central bank, completely compliant T+1 physical demand, which, as we will see by our next episode in 2 weeks, has now begun to activate sub-spot 3,300. We saw that today again. As we drew attention to and linked a copy of in our last episode, I've just put it up again for you. UBS, along with the ECB Financial Stability Review, is drawing attention to billions of unbacked, unallocated paper gold positions, identifying large foreign counterparty derivative exposures that simply must be bought back into rising prices. So while we've just evidenced a Fed-sanctioned last kick at the can, creating more unbacked, unallocated gold, there are far too few speculators to lay this liability onto. So to gain sufficient traction, they resorted to literally robbing the few remaining producers that they still finance. Now, we'll start by looking at these footprints, and then we'll look at what to expect during the third quarter. So this would be a really good time to dig into the charts, as these footprints could not be clearer. So just to provide context, we're recording this just after the PM fix on Wednesday. Obviously, it's going to get published on Friday. And this is where we were recording last time, and that was on the 25th, around about the AM, in fact, between the AM and the PM fix. So between then, we did expect, if you remember, we were talking about the OCC bets. And while we expected a last kick at the can ahead of the 1st of July US Basel III non-compliance, I will say, which accelerated the drain of underpriced COMEX-priced gold into the Basel III compliant fixes. All of these are Basel III compliant fixes. The official efforts, and this cannot be ignored, and it's just so obvious, it's ludicrous. The official efforts to market the end of the quarter, the OCC, Bank of International Settlements, lease repayment bets, evidenced a perfect bid-pulled hit of what we saw as a very well-established bull pivot. In other words, this represents an algorithm that is a bullish algorithm. Perfect hit of that, and the spot 3250 round number. Now, what we're looking at here is a futures chart, and so 3250 really is, it would have been, really should have been 3262. Should have been a $12 premium. What happened into this sell-off? Something really unprecedented happened. Into the extreme chart-painted bearish sentiment, this momentum-driven follow-through selling at the Monday 30th June end of quarter open. This is the open of the trade. And bear in mind, we're talking about 1 o'clock in the morning here. However, these known central bank size bids at spot 3250 were front-run by a single tick at 3250.05. And I'm drawing attention to that because that avoided central bank bids sitting at 3250 getting filled. The low of the day for gold futures, and bearing in mind this is a futures chart, not a spot chart, so it does reflect usually a premium of around about, currently around about $8. It's been as high as 40 at the beginning of this contract. But essentially this really evidenced that this sell-off was purely synthetic, so that they could market to market, but not wanting to trip off these central bank bids. Just be aware that that's what they were doing. And it's no coincidence that those central bank bids at 32.50 spot were front run by literally 5 cents. So into all of this, we evidence the largest SGE, Asian, Saudi physical gold and silver FX related dip buying since the May 14th lows, which was in gold futures, 31.2330. Now, these central bank bids that we noted didn't get filled are still sitting there. And if the freshly sucked in naked short momentum sellers drive an unallocated gold dip below these bids, they will be alchemized at the fixes. Now, we've seen some heavy action, but we've also seen a little bit of front running here. Now, bear in mind, when you've incentivized producer selling, you've chart painted the charts sufficiently to actually suck in momentum shorts positions. These are synthetic short positions in the futures charts. They are not backed with anything. And illustrating the selling was COMEX-centric and jiving with liquidity provider affirmations that sovereign central bank SGE, SGEI, and Saudi buyers had taken everything on offer. Okay, even though it didn't fill the central bank bids, they took everything on offer towards the spot 3250 dip. The physical to paper imbalance had contracted to such an extreme that it had synthetically closed the gold to spot exchange for physical spread. Now that should have been $12 at this level. And it actually contracted it to just 45 cents. That is a massive backwardation. It is screaming that the August price was underpriced. So in other words, the spot cash price was almost the same as the August futures price. That level of backwardation screams imbalance. Fair value for the EFP, as I say, should have been $12 right here. So it really says everything. Blatant manipulation. So despite throwing the kitchen sink at gold, this entire end of quarter OCC BIS lease repayment event is serving up a huge stacker's opportunity, securing the next in a 15-month series of a globally determined, physically determined, higher priced stair step being forged with almost no easily rinsable paper speculators on board. And just look at the open interest level at this point versus the 800,000 contracts that were open in 2020, and look at the gold price now, and look at the lack of interest now. In when you consider that some 30,000 of this 445,000 lot open interest is actually momentum shorts that will get rinsed. So the open interest here has risen into short sellers and will easily be rinsed. And if you look, we've been following this for a long time, each Bank of International Settlement repayment, bar for a couple, have been paid at higher and higher and higher prices. And despite every effort here, the BIS repayments were still repaid at a very similar level to that was repaid at the end of May. So the end of June, we see them being repaid again without any discount. They're looking for discounts. And this continues all the way up. So with what we look like, what we figure is another higher stair step, it's time to look at what to expect into the third quarter. So with that in mind, this excellent premium zero-head piece authored by Bloomberg's Simon White really sums up the major gold bull drivers very well. Now, it's interesting because Bloomberg used to ignore gold completely for years and years and years. If anything, they would have something negative to say about it. More and more, we're seeing stories about gold. They're looking at it as an asset class they've never looked at as before. So Simon White sums up the major gold bull drivers extremely well. And that's why I'm going to actually share this, because, and obviously, it's undermining this so-called gold congestion narrative that we start hearing everywhere being spun by Citi and JP Morgan. So I've put the link below this episode, but it is a premium zero head piece. So for those people that don't have a premium subscription, here's some screenshots, really just to illustrate the comparative underperformance versus the late 1970s rally. So this is as well as how directly after, as you can see, the SWIFT messaging system, you can see how when that seized Russia's reserve assets in March 2022, global central banks and reserve managers stepped up selling weaponized dollars for zero counterparty sanction-proofed physical gold. Also, further illustrating this current central bank-driven rally is the next in a series of higher physically supported stair steps. In volume terms, at 36,000 tons, central banks now officially hold more gold than they have ever held since 1970s. It's well illustrated there. However, what's not reflected here is that a large percentage of central bank gold reserves bolster military assets. And as such, real gold assets are as closely guarded a secret as weapon systems and strategies. And this is why official reserves do not include unreported BRICS, which is primarily Russian, Chinese, and Saudi, 400-ounce monetary gold accumulations, which also picked up significantly in March 2022. So not including what is secretly held by the Chinese generals, empirical evidence suggests that in aggregate, including the 2,292 officially held reported gold that China owns, Beijing has salted at least 35,000 tons of gold inside the state-held banks. I'm not alone in thinking that. That is widely held view from anyone that's connected to China. And in addition, there's 31,000 tons of official Chinese citizens' gold that they own. Now, in fact, that exceeds that of India's private holdings, which is about 30,000 tons. So it's now exceeded that. Now, while there have been multiple Indian government attempts to incentivize their citizens to lend their gold, deposit their gold into government-sanctioned lease buyback structures for the purpose of their governments, what do you think? Leasing into the market to protect the foreign, as part of their foreign exchange strategies to maintain the value of the rupee. All of these efforts have failed to attract any interest. Why? Because Indian people are too savvy to be suckered into that. Whereas if we compare that into the very real threat of a US-China, South Seas, Taiwan war, should Beijing need to bolster their already large gold reserves, as we saw a trial ballooned in 2023, which we covered in an episode back then, Chinese citizens' gold could be patriotically leased into the state with the PBOC assurances it would be equitably returned at a higher price. In other words, an investment choice. As such, in a time of war, Chinese physical reserves could amount to a massive 70,000 tons of gold. That is a huge number of accruing of gold. And also, for the same reasons, the 2,330 tons of officially reported Russian reserves are also grossly underestimated, more likely closer to 12,000 tons. In aggregate, current BRICS countries hold in excess of 10 times as much gold as is held by the US Treasury. However, while BRICS gold is fully fungible and 100% Basel III compliant because it's physical and it's deliverable and fungible, US Treasury gold is reported to be directly linked to these billions of the likely rehypothecated, unallocated OCC bets, which is currently in the late stages of being stick-handled by Citi and JP Morgan. In fact, the only global central bank left fighting a rise in the gold price versus the dollar is the Fed. And as we've just witnessed into Monday's most recent OCC mark-to-market event, billions of dollars of non-Basel III compliant, unallocated FX gold derivatives had to be squared. However, with less speculators left to wash and rinse these liabilities into physical demand, it's all about to change. Now, add in a late in the day reconversion to gold by developed market central banks. That's undoubtedly going to push gold higher. And here, have a look at the sheet here. And it really, retail buyers are only just waking up to gold as a safe haven alternate to US Treasuries. With many funds not mandated to own physical gold, they have to buy an ETF. So US-facing gold ETFs have actually started to attract very sticky long-term investment demand that is very difficult to rinse out in traditional ways. So in order for the Fed to unwind its impossible to maintain gold pricing efforts, there's only one solution. Treasury gold must be revalued from $42 to market. And for US Treasury gold to mirror or equally globally fungible Basel III NSFR compliance, billions of non-Basel III compliant unallocated FX OCC bets have to be bought back at market. So as soon as the Treasury gold revaluation account is marked to market, every other central bank will do exactly the same. Thereafter, the US will join every other central bank that is already benefiting from a higher gold price. And liquidity providers estimate most likely gold will rally to a realistically plus or minus $8,000 fair value per ounce.
Hey, Andrew, this week we've had a lot of questions in particular about silver. So what are you seeing in silver now? Because it's been acting very well into the otherwise tariff-induced volatility. What do you say?
Yeah, Shane. So I think best thing to, let's just pop in to the charts for a second, because I think it illustrates it so much better. Now, with that in mind, into this big gold rinse, let's look at the bullish silver structure. Now, for that, we're looking at the futures chart, which is currently trading at around about an 17 or 18 cent premium to spot. That will reduce to at par with spot towards the end of the contract. It started off at about 53 cents to premium. So just to understand that this is a futures chart. This is where this is where all the gaming occurs. So that's why we look at that. So let's look at this bullish silver structure, which also exposes the Fed to undeliverable OCC bets that they're also trying to square. And if you remember in our last episode, which was recorded one day after the silver options bet was squared, in fact, around about here is when we recorded that. These official OCC bets were driven down to the exact 35.20 sweet spot. I mean, right to that level. Sweet spot in spot was exactly 35.54 in futures. And what did we see? Immediate short covering. And we looked at it last time, but just really bringing your attention back to it. So the gold short rinse efforts into OCC that's being squared on the 30th evidence another round of insider short covering in silver. And this was the gold-driven discount, and insiders knew to buy this back up. Reason being, with COMEX silver market paper settled liquidity alongside producer financing initiatives leaching out into the Chinese physical exchanges, silver has now largely escaped the LBMA stranglehold. And these same actors are having difficulty in containing silver, which has not fixed below spot 36 since the 5th of June. We would view any offers to sell silver at current levels as a stacker's opportunity to load up.
All right, Andrew. And now you had close contact, we understand, that was at the BRICS summit recently here. Can you give us some feedback, or what's your take on what just went down there?
Yeah, this week's very productive BRICS summit just ended on Monday. And it elicited a pushback from Trump, who came back saying it was anti-American, et cetera, and talking about putting some big tariffs on the BRICS nations. But in keeping with the overall BRICS mandate of essentially taking barriers down and to empower multipolarity, the focus of the BRICS summit has been really on accelerating financial multipolarity, now facilitated with the expansion of the new development bank, the NDB, bolstering its intra-BRICS national currency trades benchmarked to a weight of gold. Even secondary, more everyday general BRICS pay transactions, which are not directly backed by a weight of gold, are settled within the BRICS clear system, where the FX value of each nation's currency is weighted by the percentage of gold backing up that currency. So with gold markets now being discovered in Asia, as Bloomberg recently drew attention to, it provides the BRICS autonomy. Now, Dilma Rousseff announced she came out, in fact, before the BRICS started. She announced the new development bank had launched a multi-billion-dollar investment fund. Now, you know where that's coming from. Now, Russian Finance Minister Anton Siluanov confirmed that the NDB is formalized as a BRICS sanctioned tariff-proofed cross-border settlement hub. They knew that the tariffs were coming. It's very important that they bypass SWIFT. And so this is backed up. This program is backed up with loan guarantees for mega infrastructure projects across the BRICS sphere. So in other words, you don't have to go borrowing money from your enemy. So in short, with 85% of the world's population and rising economic weight, Trump's tariffs are really driving BRICS nations to actually consolidate resources. And the NDB will provide the necessary financing. And there's a lot of instruments under this initiative. Huge initiative here. Now, there's a lot of public information available here. And this covers BRICS Pay, BRICS Gold-backed Unit, the loyalty, the business version of BRICS Pay, and the upcoming loyalty programs. It's worth having a dig into this. It's publicly available. Gold, bottom line, is strengthening the BRICS currencies at the expense of the dollar. We also expect a new BRICS currency bill note to be launched. It was shown in front of the camera. Now, as gold is already being discovered in the Eastern physically backed markets, the formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle. And it will actually be the death knell for the COMEX if it doesn't become Basel III compliant. We've got Singapore, we've got Shanghai, Hong Kong, Russia, Brazil, Africa, Southeast Asia. They've got sufficient physical market liquidity to benchmark physical gold price discovery and to set gold on the decentralized, trustless blockchain rails, valuing the gold price in real time and based upon real supply-demand fundamentals. This is what we've all been wanting the West to do for 50 years. Now, the BRICS nations in aggregate have accrued sufficient physical market liquidity to benchmark a self-arbitraging, fungible gold price for trade of a T+1 settlement, but it's actually going to be T+0. This 7-second settlement process will be set on the already tested 40% backed decentralized sanction and tariff-proof blockchain rails. Every single gold settlement transaction will be Basel III, first year, a high quality liquid first year asset, and fully compliant. Otherwise, it wouldn't be fungible. And this is a real global price discovery process. And as it gains liquidity, it will push back against the underpriced paper diluted Western exchanges. And while these bullion presented at the local London fixes is actually Basel III compliant because it has to be deliverable, these benchmark fixes currently only discover a small percentage of all of the CMA LBMA transactions. This is about to change. And as liquidity migrates into the globally fungible T+0 physical exchanges, a real supply demand will emerge, and it will backwash into the FX fixes. So China's cross-border payment system, the CIPS, already interconnects 4,900 banking institutions. And while ignored by the mainstream media, it's not gone unnoticed that the Chinese SIPS platform overtook SWIFT transactions in May. So to sum up, this current paper-driven gold price suppression leg has really just opened one more opportunity for us all to join what every other central bank is doing, swapping, depreciating, debasing fiat currencies to load up on physical gold and silver, this time into bargain basement prices. Guys, girls, everyone, I look forward to hearing your stories in 2 weeks from now.
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you goes out to Andrew Maguire for sharing his deep market knowledge. And also thank you for tuning in and being part of this growing global community. So if you're new here, make sure you hit that subscribe button and tap the bell so we'll notify you as soon as the next edition comes out and as soon as we go live. And also, if you've been with us for a while, please help keep spreading the word about this channel by giving us a like right now. Hit that like button. Share this episode with someone that you know needs to hear this information. So get your questions into Andrew Maguire. All you got to do is look at the link below. Click on that link. You can record your question, and we may have you on the next episode of Live from the Vault. And with that, we'll be right here again next week with more truth that you won't find on the mainstream media. And until then, remember, buy physical, make sure it's backed 1-to-1. We'll see you next week. Bye for now.